have as many people as we do. We've got attendees from as far west as Idaho and as far east as Kentucky, so lots of people in between. This is Sue McEntee, and we are very excited to have with us today Walt Mozdzer from Syverson Strege and Company. But before we get started, let's talk about a couple little housekeeping details. I'd ask that if you have questions, you can go ahead and type those if you are on via webinar, and we'll get to those at the end of the presentation. And anybody at the conference here on site will do the same thing. We'll hold all questions until the end. We'll have one additional webinar next month that will be about the plan giving toolbox that CGRC provides and just some more information about that. And then we'll go on a little hiatus for the summer and back again in the fall. Hopefully all of you will continue to get the emails that talk about the webinars that we're doing. Without further ado, I'd like to introduce Walt Mozdzer. Walt is a certified financial planner and also a chartered advisor in philanthropy. And if that's a term that some of you are not familiar with, I would recommend that you go out to the American College or the Advisor in Philanthropy website and check that out. It's a great designation to have. Walt is a senior fee-only financial planner with Syverson Strege and Company here in Des Moines, Iowa. And today he's going to discuss how to use charitable tools to reduce income tax in a high-income year. Walt?
Thanks, Sue. This presentation, just fair warning, is a little bit technical in nature because we are talking about charitable tools and how to reduce income tax. And so it can get a little bit numbers heavy at times. I'll try to keep it moving along so so your eyes don't glaze over. But the main point is that I wanted to bring forward some case studies that illustrate how we, as financial planners, actually implement some of these tools. A lot of times you kind of hear about them at educational seminars and so on, but I wanted to, really kind of bring it down to ground level and show you how they work in practice and how and when we implement some of these tools. So it is a bit text-heavy in the beginning, but I do bring in some pictures and diagrams later on for those of you that are visual learners. And so it'll kind of break it up a little bit. So let's go ahead and just jump right in here. Okay. So, Sue's already talked about my bio. I think the main thing is that I've been a CFP, a Certified Financial Planner, since 2001. And I've sort of been in the trenches doing philanthropic retirement planning and estate planning for multiple numbers of clients, and I've kind of seen how these tools work in a day-to-day setting. I did receive my so-called CAP designation, the Chartered Advisor in Philanthropy, probably 2 or 3 years ago through the American College, and that's been useful as I go to the Advisors in Philanthropy conference, which actually is coming right up next week in Chicago, and that's a place where you can go and learn more about these charitable tools and how you can interface with donors and clients in that respect. So let's start off talking about taxes. And tax rates, we're not going to get into all the, the nitty-gritty of how the marginal tax rates work, but I just wanted to point out that if you look there on the left column, there's essentially there are 7 different tax rates at the federal level. So these are federal taxes. And if you just earn a little bit of money, you're going to pay 10% tax. If you earn a whole lot of money, you're going to pay close to 40% tax. And this is actually for the single, so if you're a single taxpayer, these are the different dollar earnings that you would apply to different rates. So a few years ago, the top rate was 35%, and then they raised it to 39.6%. And you can see that a single person would have to make more than $406,000 to get to that point. So if I click again, you'll see the married filing joint table kick in, and you can see that that the incomes actually are expanded. So if you move my mouse here, there we go. So you can see that essentially this range of income doubles to twice as much for a married couple, and that extends down a couple of rows, and then it's not quite double. But most people are filing either as a single or married married taxpayers. There's a couple others, married filing separate and head of household. We're not going to get into the detail there, but it's another whole set of numbers. So you can see that high income folks are going to pay in that 30% range, and that's not on all of their income from $1. It's a stair-step system, so you pay 10% on the first increment and then 15% on the next amount of income, so on and so forth. So, but this is what we call the marginal rates. Now, for those of you who are married making more than $250,000, or if your donors are, there's actually a new tax this year, which is called the Medicare surtax, and that's another 0.9% on earned income. So W-2 income, salaries, bonuses, and so on. So what you end up doing is you add the 0.9% to the 39.6, and that puts you over 40% for ordinary income. The last row there speaks to investment income. So if you make above a certain income level, you're going to pay 3.8% on things like interest, dividends, rents, royalties, capital gains, and so forth. So that's not going to be taxed so much on your ordinary income as it is your investment income. So what does this all mean? It means some folks are paying a lot of tax, and that's where philanthropy can really help. Now, what about the state of Iowa? I know you all aren't all in Iowa, but if you're coming from a state that has an income tax system, you're going to have something that looks similar to this. And so here in Iowa, we have essentially 9 different brackets, but you hit the top bracket at a pretty low income level. You can see about $67,000. And notice that it doesn't matter in Iowa if you're single or married. Everybody pays the same at the same rates. There is no relief from the so-called marriage penalty. So here's what it really boils down to. The top taxpayers, the donors that you're really going after, could be losing 50% on their top income. So you got the top rate of 39.6. You add to that about 9% here in Iowa, or whatever your own state's marginal top rate is. And then Medicare, the Medicare surtax is another 0.9, so pretty soon you're up to close to 50%. And that's a pretty high number for anybody. So that's a big bite. In addition, though, if they have capital gains or even qualified dividends, for those high earners, it's a third higher than for the average person. Most people pay 15% long-term capital gains rates if they're selling stock or mutual funds or they appreciated farmland. However, if you're making above $450,000 of adjusted gross income, of taxable income, you're going to pay 20%. Plus, there's that nasty 3.8% investment income tax on top of that. So you're really paying 23.8% plus state. And so I think here's where philanthropy can sort of enter the picture. Philanthropy and the tax reduction strategies that we can bring can really kind of redirect money that's headed to Washington, D.C., and just keep it inside your own community. I think of in terms of the so-called velocity of money. If you've ever heard that term, money touches about 6 different businesses or people as it sort of circulates throughout a local economy. And I think ultimately that helps everyone to prosper as opposed to sending it to D.C. where it's going to be spent at the rate of $430 million an hour. It's going to basically vaporize in no time. So that's kind of our mission here, is to help you understand how you can make this all work for your donors and their own financial goals. So I'm going to start off with case study number 1. And case study number 1 of 3 case studies is going to focus on a deferred comp payout. So a deferred compensation plan, the way these typically work is they're often found among corporate executives, at the vice president level or above. And these folks who have these plans have to elect years ahead when they want to receive this money. And the money typically comes out in a lump sum, or it could come out in a number of yearly payments. But for this example, we're going to say that this executive receives a lump sum of cash from his deferred compensation plan all at once. So this is not a 401k payout or a 403b payout. It's a deferred comp. Let's say, for case of example, it's $600,000, which sounds like a lot, and it is a lot. But that's not atypical from what we've seen. Let's assume also that he's not retired, he's still working, and his annual salary and bonus in this same year is $275,000, which is also realistic. And so what happens here? Well, the $600,000 is ordinary income. It piles on top of the salary and the bonus that he receives already for that calendar year. So the entire $875,000, he's facing a big tax bill. It would all be taxed at once. So that's a big bite. So he comes and says, I need a way to reduce my tax bill. This is too onerous. And so we go through the planning, and we notice on his tax return he gives about $10,000 a year to charity. Because we collect the tax returns, and maybe that's not a benefit that, or the luxury that you have as a planned giving person, but again, this is how we kind of put it in practice. So our solution, after kind of looking at different possible solutions, we land on creating what's called a Charitable Lead Annuity Trust, or a CLAT. So the acronym is CLAT, and a CLAT is an arrangement where the donor irrevocably transfers, so this is an irrevocable decision, assets. In this case, we've got cash from the Deferred Comp plan, and we're putting it into a CLAT, which, by the way, is a taxable trust. It means that whatever interest, dividends, capital gains are generated inside that trust are going to be taxable to somebody, and we'll talk about who here in a few slides. That CLAT then, you essentially attach a spigot to it, and that spigot distributes income payments to at least one charity, so it could be multiple charities, but let's just say to a charity, during the trust term. So a trust term could be 10 years, it could be 15 years, it could be 20 years. It's determined by the donor who ultimately would set this up. And the donor gets a charitable deduction equal to, kind of a today's value, or what we call a net present value, for the future annual payments made to charity. And when the CLAT ends at the end of the trust term, the donor gets back the principal or the money that's still inside of that trust. We call that corpus. So that comes back to the donor. So here are some visual examples of how this would work in practice. So you've got the happy donors on the upper left. They write a check to this Charitable Lead Annuity Trust for $400,000. So that's the funding mechanism. There's no tax on the transfer as far as putting it into the trust. Once the cash is inside of the trust, it can be invested. So you can invest it into a stock portfolio or a portfolio of mutual funds across different asset classes, and that's pretty much the expected approach here. You wouldn't leave it in cash. And then the third benefit there is, the donor gets a partial income tax deduction coming back to him. And you'll see that here in the next slide. So the income tax deduction, as I said, is equal to the net present value of future annual payments to charity. It's not a full deduction, so if you put $400,000 in, you don't get a $400,000 deduction. That's not quite how that works. But the tax refund from that income tax savings is going to result in cash back to the donor. So whether they reduce their current tax liability to a level where they get a refund or they just pay less in, it's a benefit in today's value, in today's dollars to the donors, to the client. If they can't use that tax savings in the current year, they can carry it forward for up to 5 additional years until they do use up the full benefit of that. So in the third step, you're going to have income passing from the trust down to charity. So this vertical line, vertical arrow downward, represents the income that gets paid out to charity on an annual basis every year for the entire duration of the trust. Now, the donor can determine what that amount is. It's not predetermined. The government doesn't tell us. The donor says, I want to pass 3% a year or 4% a year to charity, and that can be written into the trust and the document. Now, here's another twist. The charity could actually be the donor of the grantor's own donor-advised fund. So the DAF, a DAF could be created that says that the John and Sally Smith charitable fund or charitable investment fund. You can have any name that you want. And the donor, of course, can get recognition during life for the gifts that are going to be made to charity. Step 4 is once the trust runs its course, and it could be a 10 or 15-year trust, for example, there's no tax due at the end of the trust term. So it just simply comes back to the donor, and the money can get re-registered into an account in the donor's sole name, or if they're married, in their spouse's name as well. And that money can come back and just add back to their base for their own retirement and become part of their existing nest egg. Now, I just had a client couple in another state. They set one of these up, a CLAT, back in late 1998. It was a 15-year trust. And so at the end of last year, in 2013, that was the 15th year, and I helped them essentially terminate this trust, where the money just literally we transferred it from the trust account over to their own name, and there was no tax. The cost basis simply carried over to their personal account. And it's almost a non-event. Other than that transfer, there really isn't a whole else to do other than to file the final, trust tax return and so forth. But it's really not a complicated thing to get that money back to the donors. But what about some outcomes? Well, remember we put $400,000 in, and notice here it says Grantor reversionary CLAT. Grantor simply means that it's a taxable trust. And the grantor, or the donor, same person, is going to pay income tax on the interest, on the dividends, on whatever capital gains are generated inside of that trust. So the fact that they get a tax deduction on the front end also means they have to pay a little bit of tax, which can be minimized through appropriate investment strategies. They have to pay a little bit of tax on an annual basis. The reversionary part speaks to the fact that the donor gets that money back. So it reverts back to them as a regular person, comes from the trust back to them. So in this example, look on the blue box to the right. So I ran some just scenarios in a software package called Lineberg's Number Cruncher. And we used an AFR, which is applicable federal rate of 2.2%. That's the rate that the government gives us and we have to use in running illustration. It's a rate that changes on a monthly basis. What works in this case is when it's such a low AFR, you get a better tax deduction. So the lower the interest rate, the higher the tax deduction, everything else being equal. So we're still in a low interest rate environment, which works well in this case for kind of leverage purposes. We're also assuming that the investments inside the trust grow at 6% a year, which we know they're going to vary. It's never going to be exactly 6, but we have to model it. And then the charity payout rate, which is what the charity gets, is 3%. So what's 3% times 400,000? $12,000 a year. That's what's going to be sent out to charity on an annual basis. In this case, for 20 years. We used a trust term of 20 years to run this illustration. And the quarterly income payments, they're going to be quarterly as opposed to annual. So you can see that distributions of 12, the total payout to charity is $240,000. The amount going back to the donor in 20 years is $831,000. Now, why is it higher than the $600 he put in? Well, because we're growing it at 6%, we're paying out 3, so that 3% difference is being added to the trust account or the corpus each of those years for 20 years. So it actually grows higher. Now, if we discount that back to today's value using a 6% interest rate, it would be worth the $831,000 in 20 years is worth $259,000 today. If that makes sense. We have to kind of discount it back to figure out, well, what's it really worth if it were today? And it's $259,000. So at the 39.6 marginal tax rate, that $194,000 deduction is worth almost $77,000 in terms of a refund at the federal level. Here in Iowa, it's worth about $17,400. So you can see we're adding those up. So your total tax refund is about $94,000. If I add back the present value, so that amount he's going to get back in 20 years, discounted back to today's number, that's $259,000. So if you add all that up, this strategy is really worth $353,000 in today's value, or in today's dollars. And remember, Charity got $240,000 along the way. And keep in mind, this donor was giving away $10,000 a year, and $12,000 was going into that donor advised fund. So he still has, at the end of the trust term, he still has $40,000 to give away in his donor advised fund, and his spendable cash increased because he was giving the $10,000 out of his charitable lead trust instead of his checking account. So you got to factor that in. He saved giving $10,000 a year away for 20 years, which is another $200,000 benefit to the donor that I didn't even put on the slide. That's just gravy on top of everything else. Now, another thing that you need to remind yourselves here is the fact that the IRS is going to tax the entire $600,000 when he received it. And so the initial tax bill would be pretty high. It would be about $270,000. So you're going to want the donor to put aside the other $200,000 he didn't put into the CLAT and reserve it for some of the taxes that he'll owe. The other $70,000 he would owe normally is really zeroed out by these deductions that he gets from the CLT deduction. So I know I'm kind of traveling a little fast here, and it's a little technical, but I just want you to kind of get the general sense that this is a strategy that would really work for a donor like this. Now, of course, they have to have charitable intent, but all of these examples assume that. So if you have any questions, jot them down, and I'll try to address them at the end of the presentation. So other considerations, an attorney is needed to draft the trust document. Of course, there's upfront costs, there are costs to establish this. You're not going to do a CLT for $50,000. It just doesn't make any economic sense. And of course, there's some additional complexity in administration, but there are folks you can hire to handle tax returns and all that goes along with setting up a CLT. You also have to remember that the money is inaccessible when it's inside of that trust. So you can't just reach in and take $10,000 out for a new roof on your house. And you have to have other funds available for things like that. And the other thing is a bad investment outcome could reduce the amount that comes back to the donor. So you got to be careful when you invest that money that it's not too aggressive, because if it is and the market conditions suddenly turn against you, that could actually devastate the account and the ability to service the further payments to charity, and ultimately devastate the amount coming back to the donor. And finally, this is kind of just from experience, setting that payout rate too high could actually conspire against the donor in the end. So what do I mean by that? People's memory of that tax deduction in year one is relatively short. They tend to remember for about 1 year, and then you still have 19 years to run the trust, and you keep reminding them, well, remember that tax deduction you got in the first year? So you don't want to let the tax tail wag the dog here too much, because if you do, you'll end up, I guess, creating maybe some bad feelings with your client or your donor, and so you have to be sort of careful to walk that tightrope. So case study number 2. Here's a little bit different scenario. We've got a husband and wife, ages 69 and 67 respectively. Let's say they have a $600,000 of Apple stock, and this could be Facebook stock or Google stock. It doesn't matter. Point is, it's highly appreciated, has very low cost basis, and they want to retire. The husband wants to retire, and they want to create some income. And they also want to diversify some of that concentration risk that they have for the investment. Now, let's assume for the case study that their income is $450,000, which puts them in the 23.8% capital gains bracket, plus state tax on top of that on any outright sale. If they just went out and sold it, they would lose a fair amount of taxes right out of the gate. And it also, here in Iowa at least, it could trigger alternative minimum tax, which I'm not going to get into a lot of detail, but there are 2 brackets for alt-min tax. It's 26 and 28%. So they might think they're going to only pay 15, but they could end up paying 26 or 28 if things don't go exactly like they think. So they come to us and say, we want a way to help us figure out how to reduce our tax bill and also create an income stream for our retirement in the future. So our solution is to create a CRUT, a Charitable Remainder Unit Trust. And a CRT, I'm assuming many of you on the call probably know the basics of what a CRT is. It's an irrevocable, tax-exempt, so different from a CLT, tax-exempt trust, into which somebody puts cash or property. In this case, we're putting Apple stock into it, in return for an income interest payable for their full lifetime, could be a married couple or single, or for a term of years, like say 20 years. Now, when the trust terminates, which is a nice way of saying when you pass away, the trust assets are then transferred to charity, and that's named in the document. It's all determined by the donor, if the donor can name one or more charities. But ultimately, what remains in that account is going to go to charity. Okay. So here we go with the kind of illustrations again. Step one is you put the Apple stock. Well, I'm assuming here that you create the CRT first. But assuming it's created and open, the donors would put Apple stock into the CRT, and that's just a way of, say, titling it from a brokerage account or an investment account into an account that's set up in the name of your CRT. And so there's no tax on transfer, just like the first example. No taxable transaction on the sale of the asset. So if there's $600,000 of Apple stock and you sell it, what happens? Well, suddenly you have $600,000 of cash inside of that CRT. No taxable event occurs at that time. The partial income tax deduction is basically based on the amount that ultimately goes to charity down the road, and that's, that could be years and years down the road. But actuarially, there's some tables and some software that helps us illustrate what that tax deduction would look like. And so that's going to come back to the donor in step two. There we go. So in step two, we get a partial tax deduction. Because this is long-term capital gain property, the donor cannot deduct more than the equivalent of 30% of their adjusted gross income for that first year. But again, you can carry forward the deduction for up to 5 additional years. And just like in the CLT, the refund from that tax savings results in kind of a bonus cash inflow for the year of the contribution. So similar in terms of how the CLT worked. Same with the CRT. So again, you can see here's the income stream that comes back to the donor. So suddenly they get cash flow from what was Apple stock. Now it's in a diversified portfolio. They're meeting their retirement income goals to an extent. And they might also get an inflation hedge. If the portfolio grows faster than what they're pulling back out for income, that every year that payout rate is going to be reset at the end of each calendar year, which creates inflation-adjusted income down the road. And that's important to kind of, prevent inflation from eating away at your purchasing power. Also, that entire amount in the trust grows tax-free. The only time you're taxed on it is as you take the money out. As you receive income, the tax nature of that income just passes from the trust back to the income beneficiary. And then I drew a dotted line there across the top showing that in a CRUT, you can make additional contributions. So if he were to sell further stock down the road, put it in the trust, I should say put it in the trust and then sell it, he could actually get another income tax deduction for that and increase the income that's being returned back to him. So again, benefits in step 4 here, the donors can get recognition for the gift during their lifetime. If they have an estate tax problem, if they have a net worth that's high enough to have an estate tax problem, they'll get an estate tax deduction, or actually, I should say, remove the assets from their taxable estate is probably a better way to say that. But the CRT would not be includable in their taxable estate at death. That's a clean way to say that. Also, a possible reduction in estate settlement costs because the standard probate fees would not be applicable to the assets inside of that CRT at the second death if it's a married couple. So, in Iowa, that's about 2% of a taxable estate. That would be avoided in this example. So there's some, some benefits that would come back to the donors there. So again, let's look at the blue box on the right. Again, we're assuming a growth rate on the investments of 6%, a payout rate in this example of 5% and a trust term of 20 years, quarterly income payments as well. So remember we put the $600,000 in. Go to the third bullet. You'll see there's distributions that begin at $30,000. That's 5% of $600,000. The second bullet there shows the donor gets a $228,000 deduction. So remember I said it's partial. It's not going to be the full $600,000. He gets $228,000 in this example. And we use an AFR of 2.4% here to determine that. So over the course of the lifetime of the donors, they're going to get about $653,000 back to themselves. Even more astonishing is charity gets almost $716,000 in a lump sum at the end in 20 years. So here's a classic example of how you can help the donors reach their financial goals and also leave a significant amount to the community, whether it's the university or the hospital or whatever the nonprofit. It could be multiple nonprofits. And so that's a great way to kind of accomplish a couple of goals at once. So again, if you have questions on this example, jot them down, note them somewhere, and I'll try to address them at the end if there are any. Other considerations, again, you need an attorney to draft the trust document, so you're not going to do a small amount of money for a CRT. You're going to probably start at $200,000 or $250,000 for in terms of scale. There is a little bit of additional complexity in administration that goes with these vehicles. They're not a DIY project. You probably want to hire some folks to help you do some of that. The money, again, is inaccessible for the duration of the trust term. So it's an irrevocable decision. You have to know that going in. Again, same as a CLT, any bad investment outcomes would certainly reduce income. In this case, it would reduce the income to the donor. In the other example, it's a little different. But here, you're talking about affecting their income, which you have to be fairly careful how to manage that. And and the other thing I didn't even put in here is the fact that, remember, he was going to pay 20% cap gains plus the 3.8 if he sold the apple in one lump sum. In this example, you're going to spread that capital gain out over the 20-year term or whatever the lifetime of the term. So as he receives income, he's only going to be paying 15% more than likely on the income back to him. So you're using a little bit of a spread strategy. You're reducing it from 23.8 down to 15. So you're actually helping their tax situation immensely, and probably saving them a boatload of money that way. And my final bullet point is, again, setting that payout rate too high could actually conspire against the donor. Again, their memory of tax deductions is usually pretty short, so I won't belabor that point since I already talked about it. All right, last case study is a little bit different. So instead of these wealthy people with high incomes, let's look at somebody who is of more modest means. Let's say we've got a retired civil servant, 74 years old, who has a non-qualified, I should say non-qualified, not non-qualifying, annuity. Just a commercial annuity. So it's not an IRA, it's just a personal annuity that we call a non-qualified annuity. Well, let's say that annuity is worth $250,000. Let's say he bought it, he put $150 into it, bought it for $150, and it's now grown to $250. So he's got appreciation of $100,000. If he just gives it up and surrenders the annuity and takes the cash, he would owe income tax on the gain, or the $100,000. Now, the thing with annuities is there is no capital gains rate. You would pay regular income tax on that whole $100,000. So that's kind of a problem for him. Let's say that his income is $75,000 a year. So that's his retirement income, and he gives $1,000 a year to charity. So he's a smaller donor. Kind of careful. He doesn't want to give too much away because he might need it. Maybe his retirement income is uncertain. So here we're going to fund a charitable gift annuity. He doesn't really have enough to do a big fancy, trust strategy or CLT or CRT. So we're going to use the charitable gift annuity here. And a CGA is an agreement where a donor irrevocably transfers cash or securities or some sort of property to a charity in exchange for income, just like a CRT, but maybe on a scaled down basis. So you get guaranteed fixed income. Now, here's the key thing. It's flat fixed income. There is no inflation adjustment. So that's a little bit different than our CRUT example. So a gift annuity can be for 1 or 2 lives with, there's no minimum or maximum number of payments. They just get income for life. So here we're going to take the cash. Let's assume he surrenders that annuity. He has $250,000 of cash. He wants to put it into a charitable gift annuity. Again, no transfer tax. There's no tax on the sale of the asset. So that cash isn't going to sit in cash, right? It's going to be invested into an investment portfolio that can provide that income stream for the rest of his life, because we don't know how long he's going to live. And he does get, again, a partial income tax deduction back to himself. And that partial income tax deduction is equal to the present value of what's ultimately going to go to charity. So that income tax deduction gives them some additional cash, which is, again, kind of a nice little kicker. He'll get a refund, and he can do whatever he wants with that money. And again, the carry forward is for 5 additional years. So same rules apply from a tax standpoint. Nothing really unusual about that. Step 3 is donors get income. The donor gets an income for life. So he gets a fixed income stream. And that's, it's guaranteed cash flow. It's backed up by the charity. And what's also nice about it is for a certain number of years, he's going to get tax-free income. Now, how do we know this? Well, there's some illustration software out there that tells us he might get 8 or 10 years worth of tax-free income for the first so many years. That's not something we can just sort of shoot from the hip about. We have to run some illustrations and then figure out what that is. The final step, of course, is let's say that he lives his life expectancy, and the CGA ultimately passes the corpus or the remainderment to the causes that he really cares about. And so in this case, he probably wouldn't have an estate tax problem or a lot of estate settlement costs. He might get some recognition of the gift during life. He gets invited to a recognition dinner by the nonprofit, something of that nature. So that's a plus for him. So how did we look at this? Look at the blue box again. In this case, the donor was 74. Initially, about 45% of each payment is going to be tax-free, and so that keeps his taxes down, which he likes. The payout rate is 7.4%. So you think about that. He can get back 7.4% of $250,000 for life. That comes out to $14,250 a year, as you can see there on the left. And so that also results in a $108,000 tax deduction. Remember, I said $100,000 was taxable when he surrendered the annuity. So the deduction is actually more than what would have been taxable. It wipes out all the tax that was going to be due on that annuity, and he gets another $8,000 tax deduction kicker. And he's smiling all the way to the bank over that result. So he doesn't have to worry about investment responsibilities either, because he's handed all that off to the nonprofit. So the income lasts for the entire lifetime of the donor. It's a charitable pension plan. He's created a pension plan which he didn't have before, or if he did, he just added another one. So he'll get quarterly payments, and so I think he's been able to get out of his high fee annuity as he perceived it. He wanted to change course, and he's looked for steady income, which he found. So everybody he's particularly happy with that result. The other nice thing, though, is $125,000 of this, roughly half of the CGA amount, is going to end up back in the community. So it's going to go to those favorite causes that you've been supporting all those years. That's if he lives to his actuarial life expectancy. Now, in this case, an attorney is not needed to draft the agreement. It's simply like a 2-page agreement between him and the nonprofit. So the simplicity is really attractive to folks like him. He doesn't want to have to hire a bunch of attorneys to get this stuff done. The income stream feels like a pension. There's no cost of living adjustment. You have to know that going in. So you should have other assets to help compensate for that. Donor doesn't have to worry about investment strategy. The money is not accessible for the duration of the CGA. He's not going to be able to reach in and grab $10,000 out for himself. And the payout rates are established by the American Council on Gift Annuities, the ACGA. That's what most nonprofits will follow. All right, so in summary, the first example, this large deferred comp payout, I think of it as kind of a nest egg lockbox. Some of you may remember years ago when Al Gore was running for president, he talked about taking Social Security in this country and putting it into a lockbox. And what he meant by that is putting it into a kind of a safe so that everybody in the future would always be able to rely on it and would have benefits coming from it. So he kind of coined this term lockbox, but I'm sort of taking some ownership here and saying the CLT is like a nest egg lockbox. You're putting it into a trust. You're ultimately getting it back sometime later in life. And so that's kind of how I think about a CLAT as a strategy. You got to have other assets, of course, to live on during that time, but it could be a piece of the puzzle. The stock concentration dilemma. You created and funded a CRT to diversify and capture the entire value for future income streams for the donors, for the clients. And then here we had the number 3, the retiree needed security of income, was tired of its high-cost variable annuity, so we helped him to get out of the annuity and to set up a CGA, not only to rid him of his tax problem, but also to create a guaranteed income stream for the rest of his life. And so, you know, that kind of wraps this up with some ribbon and puts a bow on it. At this point, I feel like I've been kind of, you know, running pretty hard here. I want to pause and allow some time for questions on any of those case studies.
We do have a couple questions here, Walt, that I want to pose. On the CLATs and the CRT, you talked about the complexity of the administration and management. Who actually administers and manages the investments for those two tools?
On the investment side, it could be, you know, it could be the donors themselves. It could be their investment advisor or their financial advisor. In many cases, with the clients that I've worked with, once we expose the client to these ideas, they typically just say, well, can you help me with the investments? And then we would go ahead and just create the portfolio, create the, you know, whether it's using tax-managed mutual funds or what have you. But it could be the donors themselves if they're comfortable doing that. As far as the administration goes, it's wise to probably hire a professional administration company because, as I said, this is not a do-it-yourself project. You're probably going to get in over your head as far as trying to do this if you have no experience, especially with CLTs and CRTs. They're just, you don't want to get yourself in hot water with the IRS because something got done wrong.
Great. Thank you, Walt. We have one other question from Denise. Denise is asking, what are your thoughts on whether the IRA charitable rollover will be extended this year?
Yeah, so the charitable IRA rollover ended at the end of last year, as you know, and no, the Congress has not taken up the cause or the banner to go ahead and extend it into 2014. I think probably it probably will be extended at some point for the end of the year, but you know, who really knows? I mean, Congress has to have advocates that are going to push this through, and it seems kind of crazy that it ended without any sort of extension, but you know, lots of stuff can change, and you know, my crystal ball is in the shop. I really don't have any particular thoughts on that, other than my gut tells me that they'll probably bring it back at some point. Who really knows? Don't hold me to that.
Any other questions coming from either outside the room or here in the room? I'll take a moment to talk about a potential program next week. This really is for those people who are local. Next week on the 29th, we will be hosting a luncheon with Colin Witt. The topic is Children in Need and Those That Become Orphans, Rethinking Response and Treatment. It's from 11:30 a.m. to 1 p.m. at the Downtown Marriott here in Des Moines, Iowa. There is 1 hour of continuing legal education. Judge Witt will be sharing his expertise and experience overseeing the child welfare matters. We'll review some of the contextual history of our child welfare system, then paint a silhouette of a few of our most vulnerable children. The question of whether there are orphans or whether our system inadvertently makes orphans will be explored. It looks to be a great program. There is a $25 fee for the luncheon, but we would love to have you come. If you need more information, Walt's going to advance so that you can see his information, and you can always find us at Charitable Giving Resource Center out on the web. I'd like to thank everybody for their time and their attention today. Hope that you all have a wonderful holiday weekend and that we don't see any more of that four-letter word, S-N-O-W. I don't know about you, but I've had enough for this winter, even though I'm usually a winter lover. And I hope to see all of you next month when we explore some topics in the Plan Giving Toolbox. Have a great rest of the day and safe travels.